Welcome to the deep dive. We all face uncertainty in life, don't we? The chance things might go wrong. A car mishap, maybe a health issue.
Yeah, it's unavoidable.
And insurance, well, it's basically how we try to handle that uncertainty, right? To sort of soften the financial hit when unexpected losses happen.
That's the core idea.
We've got chapter 2 from a pretty detailed PDF here. And our mission today is really to unpack the essentials, the key concepts behind how this whole, safety net functions.
Mm-hmm.
So if you've ever found yourself a bit confused by premiums and policies, this deep dive should hopefully clear things up. Let's jump in.
Okay, sounds good. So, starting with the absolute basics, what is insurance? Fundamentally, it's a way to transfer risk.
Transfer risk, how so?
Well, you, the person getting insured, you make a contract, a legal one, with an insurance company, the insurer.
Okay.
And in return for you paying them regularly, those are the premiums the insurer agrees to take on the financial risk if certain bad things, specific losses happen to you.
Right, so I pay a smaller known amount now to avoid maybe having to pay a huge unknown amount later. But it's not just a one-on-one deal, is it? There's this idea of like everyone chipping in.
Yes, absolutely. That's risk pooling, or sometimes called loss sharing. It's critical.
Risk pooling. Explain that a bit more.
Imagine, say, a whole neighborhood of homeowners. Everyone faces a similar risk, maybe damage from a hailstorm.
Okay.
Instead of each person having to find, I don't know, 20,000 pounds if their roof gets smashed, everyone pays a much smaller amount into a collective pot. The premiums.
Yeah, the pot.
Right. Then, if one house does get hit by hail, the money to fix it comes out of that shared pot. It means the financial shock for that one homeowner is way, way less.
So the risk itself doesn't vanish.
No, it's still there.
It just gets spread out across the whole group. Makes it manageable.
Precisely. It's a collective buffer, really.
A safety net, like I said.
Exactly. And for a lot of insurance types, car, home, that sort of thing, there's a really important guiding principle. It's called indemnity.
Indemnity. Okay, sounds a bit legalistic. What does it mean in plain English?
Basically, the principle of indemnity means the goal of the insurance payout is to put you back in the same financial position you were in before the loss happened.
Just back to where I was. Not better off.
No, exactly. The aim isn't for you to make a profit out of misfortune. It's about making you financially whole again.
So, if my 10-year-old car gets written off,
Right.
the insurance pays enough for me to get another similar 10-year-old car, not a brand new sports car.
That's the idea. Make you whole, not rich. This applies to most policies covering accidents, health, property, casualty, the usual stuff.
Okay.
It's worth pointing out, though, this is different from what are called valued contracts, like many life insurance policies.
How are they different?
With those, a pre-agreed lump sum is paid out when the person dies. It's not directly tied to calculating the exact financial loss suffered by the family. It's a set amount.
Got it. So indemnity is about restoring the pre-loss state for most types. Now, you mentioned risk pooling relies on having lots of people involved.
Yes, very much so.
It feels like the more people, the steadier it would be. Is there a scientific reason for that?
There absolutely is. It's a cornerstone of insurance statistics. The law of large numbers.
Law of large numbers. Okay.
What it says, essentially, is that the more similar risks you group together, the more exposure units, they call them, the more accurately you can predict the total number of losses that whole group will likely experience over time.
So more data points mean your crystal ball gets clearer.
Something like that, yeah. Think about trying to guess how many houses out of just, say, 10 might have a minor fire next year. It'd be a wild guess, wouldn't it?
Pretty much impossible to know.
But if you insure 100,000 similar houses, based on past data for similar groups, you can make a much, much more reliable statistical prediction about how many fires are likely to occur across that large group.
Predictability.
Exactly. That predictability is absolutely vital for insurers. It lets them calculate premiums that are, well, hopefully fair and sufficient to cover those predicted future claims while still being competitive.
More houses, more stability in the predictions.
Precisely. The bigger the pool of similar risks, the less volatile the actual results are compared to the predicted results. It smooths things out.
Okay, that makes total sense. Predictability helps set the price.
Yeah.
But what if the people who are signing up are mostly the ones who think they're really likely to need it? Doesn't that mess up the predictions?
Yes. That's a huge issue. It's called adverse selection.
Adverse selection. Sounds bad.
It can be for the insurer. It's the tendency for people who believe they have a higher than average chance of loss to be more eager to buy and keep insurance compared to people who think the risk is low.
Like if I knew I had a dodgy engine in my car, I'd be extra keen to make sure my breakdown cover was top-notch.
Exactly that. Or someone with a pre-existing health condition being very motivated to get the best health insurance plan available. So the insurer can end up with a pool of customers that is, on average, riskier than the general population they base their initial calculations on.
And if they have more claims than expected,
The costs go up.
which probably means they have to raise premiums for everyone,
That's the danger. Higher premiums might then drive away the lower risk people.
making the pool even riskier.
Exactly. It can become a downward spiral. That's why insurers have to actively work to minimize adverse selection.
How do they do
A
that?
key tool is underwriting.
Underwriting, we mentioned that briefly. What's involved?
Underwriting is basically the insurer's process for assessing the risk level of each applicant. They gather information, your driving record for car insurance, your medical history for health insurance, maybe the construction type of your house for home insurance.
They check you out.
Pretty much. Based on that assessment, they decide, do we offer cover? At what price? The premium? And under what specific terms or conditions?
So they might charge more if you seem riskier.
Yes, charging higher premiums for higher assessed risks is the main defense against adverse selection. They might also put limits on the coverage, or in some cases, if the risk just seems too high or too uncertain, they might have to decline cover altogether.
Right.
Another strategy is ensuring large, diverse groups, like through company health plans. That tends to naturally create a more balanced mix of high and low risks, diluting the impact of adverse selection.
So underwriting tries to get an accurate picture of the risk to keep things fair and, well, financially viable for the insurer and the pool. Okay, now let's shift gears slightly. What actually causes these losses? I hear terms like peril and hazard thrown around. Are they the same thing?
Good question. No, they're distinct. A peril is the immediate specific event that causes the loss. It's the what happened.
The direct cause.
Yes. So fire is a peril that destroys property. A collision is a peril causing car damage. Illness or accident is the peril in health insurance. For life insurance, the peril is mortality, death.
Okay, the event itself. And policies cover specific perils.
They do, and policies generally fall into two camps based on how they handle perils. Named perils policies and special perils policies, sometimes called open perils.
Named versus special. What's the difference?
A named perils policy literally lists the specific perils it covers. Fire, lightning, windstorm, maybe theft, etc. If your loss is caused by something not on that list, well, you're not covered.
So you need to check the list.
Definitely. A special perils policy works the other way around. It basically covers all possible perils except for those specifically listed as exclusions in the policy.
So it covers everything unless it says it doesn't.
Exactly. It's generally broader coverage, but you need to carefully read the exclusions list to see what isn't covered. Things like flood, earthquake, war are common exclusions unless you buy specific extra cover.
Right. One lists the inclusions, the other lists the exclusions. Important difference. Okay, that's the peril to cause. What counts as a loss, then?
A loss is the unintentional reduction in the monetary value of something because of a peril. It's the financial hurt you suffer.
The financial consequence.
Yes. And we usually distinguish between direct loss and indirect loss.
Direct and indirect.
A direct loss is the immediate physical damage done by the peril. The fire burns your sofa, the flood ruins your carpet.
Okay, the actual physical damage.
An indirect loss, sometimes called a consequential loss, is a financial loss that happens because of the direct loss. So if that fire means your shop has to close for repairs, the business income you lose during that time is an indirect loss.
The knock-on effect.
Exactly. Or if an accident means you can't work, that's the direct impact. The wages you lose are the indirect loss, which disability insurance aims to cover.
Direct damage. Indirect. The financial fallout from that damage.
Got it.
Now, what about accident versus occurrence? Sounds similar again.
They are related, but occurrence is broader. An accident is usually defined as a sudden, unforeseen event happening at a specific time and place. Like a car crash, bang, it happens right then and there.
Sudden and specific.
Right. An occurrence includes accidents, but it also covers losses that happen due to continuous or repeated exposure to harmful conditions over a period of time.
Can you give an example of an occurrence that isn't really a single accident?
Sure. Imagine someone slowly develops lung problems from working in a dusty factory for 20 years. There wasn't one accident, it was the long-term exposure. That's an occurrence.
Ah,
Or maybe a pipe in your wall has a tiny, slow leak that causes major damp damage over 6 months before you notice it. The damage is the result of an occurrence, not really a sudden accident.
so every accident is an occurrence,
Yes,
but not every occurrence is a sudden accident. It could be gradual.
exactly. Occurrence is the umbrella term.
Okay, and just quickly, loss exposure. What's that?
Loss exposure just means any situation or circumstance where a loss is possible. It's the potential for
The
loss.
situation creating the risk.
Right. And a loss exposure unit is the thing being insured, a person, a building, a car.
Hmm.
And going back to the law of large numbers,
Ah, yes, predictability.
we need homogeneous exposure units. That mean lots of similar units, similar houses, similar cars, people of similar age and health exposed to the same sorts of perils. That similarity is key for making those statistical predictions work.
Right, you need apples compared with apples. Okay, so perils cause losses. What about hazards? We said they increase the chance of a peril happening.
Correct. A hazard is any condition or factor that increases the likelihood of a peril occurring or increases the severity of the loss if the peril does occur.
Makes it more likely or makes it worse.
Yes. Think of, say, bald tires on a car. That's a hazard. It makes the peril of skidding and crashing more likely and maybe makes the crash worse if it happens.
Makes sense. Are there different kinds of hazards?
Yes. Typically, we talk about three main types: physical hazards, moral hazards, and morale hazards.
Okay, physical first. Sounds like tangible thing.
Exactly. Physical hazards are actual physical conditions you can often see or measure. Icy roads, faulty electrical wiring, storing gasoline near a furnace, even things like high blood pressure for health insurance. Tangible conditions increasing risk.
Got it. So what's a moral hazard? Sounds like it's about character.
It is. Moral hazard relates to a person's dishonesty or, frankly, criminal tendencies. It's the risk that someone might intentionally cause a loss, or fake one, or exaggerate a claim just to collect the insurance money.
Like arson.
Uh,
Burning down your own business for the insurance payout.
That's a classic, albeit extreme, example of moral hazard. Filing fraudulent claims, lying on an application that all falls under moral hazard. It's about intentional deception for gain.
Okay, intentional bad behavior. Now, morale hazard sounds similar. M-O-R-A-L-E. How is that different?
It's a subtle but important difference. Morale hazard isn't about dishonesty, it's about carelessness or indifference to loss because someone has insurance.
Oh, it's like, oh, well, it's insured, so I don't need to be that careful.
Exactly that attitude. Leaving your car unlocked with valuables inside because, hey, it's insured. Not bothering to clear ice off your steps because if someone slips, insurance will handle it. Driving recklessly because the car's covered.
So it's more about apathy and carelessness, driven by the safety net of insurance, rather than deliberate fraud.
Precisely. Moral is about bad character. Morale is about a bad attitude towards risk because insurance exists.
Okay, that distinction is clear now. Physical, moral, morale hazards. Right, let's zoom out again and talk about risk itself. We use the word all the time, but what's the formal insurance definition?
In insurance terms, risk is essentially the uncertainty concerning loss. It's the possibility that a loss might happen.
Uncertainty. Okay. And I think I remember there are different types of risk.
Yes, the big distinction is between speculative risk and pure risk.
Speculative versus pure.
Speculative risk involves a chance of either loss or gain. Think about gambling or investing in stocks or starting business. You could win, you could lose.
Possibility of profit or loss.
Right. And generally, speculative risks are not insurable. Insurance companies aren't there to cover your business failing or your lottery ticket not winning.
Makes sense. So what's pure risk?
Pure risk involves only the possibility of loss or no loss. There's no chance of gain. Your house burning down, that's a loss or no loss situation. Getting into a car accident, loss or no loss. Becoming ill, loss or no loss.
Only downside potential.
Exactly. And these pure risks are the ones that insurance is designed to handle.
Okay, so insurance deals with pure risk.
Mm.
But not all pure risks can be insured, right? What makes a risk actually insurable in practice?
Correct. There are several key elements that typically need to be present for a risk to be considered insurable by private insurers.
Like what?
Okay, first, the loss must be due to chance, accidental. From the insured's point of view, it has to be unintentional. You can't insure against deliberately crashing your car.
Prevents moral hazard again.
Exactly. Second, the loss must be definite and measurable. You need to be able to tell when it happened, where it happened, what caused it, and crucially, be able to put a financial value on it.
Clear time, place, amount.
Yes. Third, the loss must be predictable statistically anyway. Insurers need enough historical data on similar risks to predict the likely frequency and severity of future losses for the group. That's the law of large numbers again.
Back to predictability.
Fourth, the loss generally cannot be catastrophic, meaning it shouldn't be likely to bankrupt the insurer. A single event causing massive losses to a huge chunk of their policyholders all at once, like maybe nuclear war, is usually uninsurable by private companies.
Too big to handle.
Pretty much.
Hmm.
Fifth, there needs to be a large number of those homogeneous exposure units we talked about. Enough similar things being insured to make the stats reliable.
Law of large numbers requirement again.
And finally, sixth, the premium must be economically feasible. It has to be affordable for the policyholder and relatively small compared to the potential loss they're protecting against. If insuring your shed costs almost as much as rebuilding it, it doesn't make much sense.
Accidental, measurable, predictable, non-catastrophic, large numbers, and affordable premium. Okay, that's quite a list.
It ensures the whole system can actually work.
Right. Now, when insurers look at these insurable risks, do they lump everyone together or do they categorize people?
Oh, they definitely categorize. During underwriting, they classify applicants into risk categories.
What are the typical categories?
Usually you see standard risks. These are people with average loss potential, and they typically pay the standard published premium rate.
Average risk, average price.
Then you have substandard risks. These folks are assessed as having a higher than average chance of loss, maybe due to health issues, or a poor driving record, or the type of business they run.
Higher risk.
Right. They might still get insurance, but often they'll have to pay a higher premium, sometimes called a rating. Or the policy might have special restrictions or exclusions, or in some cases, if the risk is just too high, they might be declined coverage altogether.
Okay, higher price or maybe no cover. What's the opposite?
That would be preferred risks. These are individuals or properties assessed as having a lower than average chance of loss. Think very healthy non-smoker or a building with excellent fire protection. Insurers like these risks.
Low risk, lower price.
Exactly. They often get rewarded with discounted premiums. It pays to be low risk.
Standard, substandard, preferred.
Literally.
Okay, so we understand risk, how it's assessed, what makes it insurable, what do people and businesses actually do about risk. This brings us to risk management, doesn't it?
It does. Risk management is the whole process of identifying exposures to potential loss, analyzing them, and then figuring out how best to handle them.
It's a strategy.
A systematic one, yes. Usually involves steps like finding your risks, figuring out how bad they could be, choosing a method or mix of methods to deal with them, putting that plan into action, and then keeping an eye on it to see if it's working or needs adjusting.
And buying insurance is just one part of that bigger picture.
Exactly. It's a very important risk management technique, but it's not the only one.
Okay, so what are the main techniques? I think I've heard people talk about avoiding risk or transferring it.
Yes, there are several common methods. A handy way to remember them is the acronym STAR. STARR.
STAR. Okay, what does that stand for?
Sharing, transfer, avoidance, reduction, and retention.
Sharing, transfer, avoidance, reduction, retention, STAR. Okay, let's break those down. Sharing.
Risk sharing is basically distributing the risk among several participants. We already talked about risk pooling and insurance. That's a prime example. Co-insurance and health plans, where you pay a percentage of the bill and the insurer pays the rest, is also a form of sharing the financial risk.
Sharing the potential cost.
Yeah.
Okay, transfer.
Risk transfer is shifting the burden of risk to someone else, usually through a contract. Buying an insurance policy is the classic example. You transfer the financial risk of, say, a fire to the insurance company in exchange for the premium.
Paying someone else to take the risk.
Essentially, yes. Other ways include things like hold harmless clauses in contracts, where one party agrees to take responsibility for certain liabilities transferring from the other party. Incorporation also transfers liability from owners to the company itself.
Right. Avoidance.
That sounds simple. Risk avoidance is just that, eliminating the risk entirely by not engaging in the activity that causes it. If you're worried about the risks of skydiving.
Don't go skydiving.
Exactly. If a company thinks a particular product line is too risky, they might just decide not to produce it. Avoid the risk altogether.
Okay, reduction.
Risk reduction means taking steps to lower the chance of a loss happening, or to lessen the severity if it does happen. Installing fire sprinklers doesn't eliminate fire risk, but it reduces the likely damage.
Makes the outcome less bad.
Right. Wearing a seatbelt reduces injury severity in a crash. Maintaining healthy habits reduces illness risk. There's also loss prevention, which is specifically about stopping the loss from happening at all, like building with non-combustible materials to prevent fire spread.
So lowering frequency or severity. And the last one, retention.
Risk retention means you accept some or all of the risk yourself. You decide to bear the potential cost.
So like not buying insurance.
That's one way, sometimes called passive retention if you just haven't thought about it. But active retention is more deliberate. It includes things like choosing a higher deductible on your insurance policy you're agreeing to retain or pay the first £500 or £1,000 of any claim yourself.
You take the first hit.
Right. Or self-insurance, where a large company might set aside specific funds, like a reserve, to pay for expected losses rather than buying insurance for everything. The key difference with proper self-insurance is that it's planned and funded, not just hoping for the best without cover.
So STAR. Share, transfer, avoid, reduce, retain. Different ways to tackle risk. Now, you mentioned reinsurance earlier, very briefly. Where does that fit?
Reinsurance. That's basically insurance for insurance companies. It's a form of risk transfer again, but specifically between insurers.
Insurers insuring each other.
In a way, yes. The primary insurer, the one you buy your policy from, might face the risk of a huge loss, maybe from a natural disaster hitting many of its policyholders. To protect itself from becoming insolvent, it transfers part of that risk and part of the premium to another company, a reinsurer.
So it helps the original insurer handle potentially massive claims.
Exactly. It spreads the risk even further, right up the chain, preventing catastrophic losses from taking down a single insurer. It's another layer of stability in the system.
Got it. Insurance for insurers. Okay, wow. We have definitely covered a lot of ground today.
We certainly have.
We kicked off looking at insurance as this fundamental way to transfer and pool risk. Then the principle of indemnity, making you whole, not rich, and how the law of large numbers underpins the predictability needed.
Crucial concepts.
Then we got into adverse selection, that challenge of riskier people signing up and how underwriting tries to manage it. We broke down perils, the causes, losses, the impact, both direct and indirect, and hazards physical, moral, and morale that increase risk.
Yeah, differentiating those is key.
We defined risk itself, uncertainty, distinguishing pure from speculative risk, and outlined all those elements needed for a risk to actually be insurable.
The checklist for insurability.
Right. And finally, we wrapped up with risk management, using that STAR framework, sharing, transferring, avoiding, reducing, and retaining risk-placing insurance firmly as a major tool for risk transfer, and even touched on reinsurance.
That really covers the bedrock principles. Understanding these helps make sense of why insurance works the way it does and why policies are structured as they are.
Absolutely. It definitely demystifies it quite a bit. So for you, our listener, as you digest all this, maybe chew on this question. How do these fundamental ideas about sharing risk, measuring loss, predicting outcomes, managing behavior, how do they not only provide financial security, but also potentially shape the choices we make, the risks we're willing to take, both personally and maybe even as a society? It's a really interesting dynamic, that interplay between uncertainty, our collective desire for safety, and individual decision-making.
Really is.
Thanks for diving deep with us today.